Dawie is the head of information and marketing at First National Bank Business and Agriculture. Dawie was a former economist at the MPO as well, and also at Agri SA. Dawie has been a speaker at this conference or this webinar or dairy school for a couple of years. And Dawie, from my side, thank you so much for once again volunteering to be a guest speaker again. Thank you. Thank you, Dawie.
Morning, Lena. Thank you for the introduction, and yeah, thank you for having me again. I'm starting to feel like furniture at this dairy school, but it's really nice. Looking forward to perhaps next year have a hybrid event, then we can see a couple of students' faces again. But yeah, for now, it's nice to be part of it again. I'm just going to start sharing my screen to get a presentation up. Hopefully, I won't keep you busy until 10 o'clock, so you might be able to have a longer break to enjoy 2 glasses of milk and 2 cups of coffee with milk in it. So Bertus, I think he painted a good picture of the economic situation for the dairy industry going forward, and I will start speaking on, you know, the things that, you know, most veg students, and I know there's not only veg students on the call list, there's other people as well, but for a lot of people this might be the Achilles heel. You know, if you look at the financing and especially the terms and concepts. So just to start off, you know, in case there's some media on the call again, you know, we in the bank like to use some big words and long disclaimers. I prefer to keep it simple. I will be responsible for what I'm going to say, and not for what you understand about it. So just keep that into mind. Otherwise, this is not financial information. Please don't make decisions on that, but that's something else. So just to give a brief background, you know, the changing environment in the dairy industry, and Bertus touched briefly on that. But we know, you know, over the last couple of years, and especially since I've joined the MPO and left again, you know, farmers is definitely getting bigger. They are getting less, but definitely bigger. It's not as if the national herd size have reduced, you know, a lot over the last couple of years. The cows just moved from the neighbor's farm to the bigger one. It's not something that's happening only in South Africa. It is an international trend, you know, and it's not only something that's happening in the dairy industry. It's a trend that run across most industries in the world, especially in agriculture, where economy of scale plays a big part. Since 1996, we in South Africa also had a free market system. Before that, we had a dairy board or the milk board, and then the dairy board again, where there was a one-channel marketing system where the price of milk was determined by the Minister of Agriculture, and it was easy. It was a cost plus based price, and farmers, you know, were able to make some money. Since 1996, since deregulation of the agricultural market, you know, farmers had to become jack of all trades. You know, they had to be a producer, they had to be a marketer, they had to be a negotiator, they had to become everything. In some instances, you know, they had to be vets as well. So it's not only you know, keeping it simple and just farming. That also applied to the industry players. It's not only on the farming industry. You know, our industry players across the board also had to adapt to this changing environment. And I'll be back about or talk about the changing environment a bit later as well. If we look at why this is happening, a lot of it's, you know, attributed to technology change. we focus on in the agri industry a lot on the political and business change. But if you look over time, the change isn't as big as we think it is. The social and the technology change actually happens quite faster than those two that we think that's important. If you just think, not a long ago, things like Twitter and YouTube and LinkedIn, those things didn't exist, and now it's a part of our daily lives. Another thing, things that jobs that didn't exist 5 years ago, or perhaps a bit more, app developer. And some of us might be looking at this webinar on our phones via an app. That's things that didn't exist, 5, 10 years ago. Now, although the farmer and the veterinarian, they've existed for decades, and actually for longer than that. Some interesting stuff here, energy manager. Helena talked about load shedding. I think we need a couple of more energy managers in South Africa, but that aside, cloud computing operations manager, online reputation manager. Now, those are things that we also need to take account of, in our new business environment. So why is it important to have a basic understanding of the subject? And the subject here is now the financial ratios and financial statements and so on. It's not only important for your own practice, for people that's going, or students that's going into practice, or farmers that's already farming, or which is looking to farm in the next couple of years, or growing from a small scale farmer to a more bigger commercial farmer. It's important to know what's going on in your practice, because everything that a farmer does, is linked to a kind of financial activity. Whether and I'll show the next graph now, but if you look at financial results, that's used in our performance analysis. Now, as a salaried worker, you sit in front of your line manager and you do a performance analysis. When you work for yourself, as a farmer or as a vet that owns a practice, you also need to do that performance analysis. And against what do you do that? And that's where your financial statements and your budgets come in. As I've said, everything that a farmer does is linked to a kind of financial activity. Now, if you look at your calving index, you start with that, and your yields. That links to your quality, your quantity of your production, your price. That's linked to your milk sales per cow, or you can do it per hectare as you wish. That links out to your gross output. And if you deduct your variable costs, which comes into your feed cost, your veterinary cost, because that can be directly linked to your variable cost or to your production. You subtract your fixed costs, which is your labor, your overheads, your cell phone or telephone rental, your rent and rates and everything. Then you end up with your net margin, and that's the one that you would like to increase in the end. So if you can increase your quantity and your price, and I know for dairy farmers it's difficult to increase that price because it's not always in their hands. Then you can increase your net margin. But in between all those, you must manage your cost as well. So what are we looking at? We're looking at some basic terms. I don't want to burden you with all the financial terms and ratios, because that can be a mouthful. A couple of key financial statements, and then in the end, where will you as a farmer, as a vet, or as a input supplier, or what job you might do in future, where will you fit in? So if we can start off with some basic terms, you've got your capital fixed and current assets. Now, your capital assets is in general also your fixed assets. For a dairy farmer, that would be your parlour, your land, pastures, and so on. Then your current assets, that would be your most important one. In this case, would be your cows, and then any other equipment that you use on the farm. Then equity. Now, equity is normally your own equity. That's your own money that you put into the business. You might also have some investors' equity in there. Then in the end, your liabilities, and that's where we as a bank are happy to be part of the agricultural sector, because we supply those liabilities. That's your loans that you have. Then we'll look at gross value of production. That's a very important one. That's basically price times output. That's the liters of milk that you produce times the milk price, and you get to your gross value of production. For us as a bank, we're looking at the net value, but we'll come to that. Then your variable costs. Your variable costs are those costs that can be linked directly to that specific enterprise. In the case of a dairy parlour, you can, that's your wet cost, because you can link it directly, your cleaning materials and so forth. Labor, to a great extent, can be either variable or fixed costs, because it depends on where they fit in. Fixed costs, those things that doesn't change as your production change, and that's normally your rent and those fixed costs that don't change. Then if you subtract all those costs from your gross value of production, you get to net farm income, which is that one that's very important for you as a business owner. And then depreciation, which is sometimes a very misunderstood term. So I'll stand a bit still with depreciation. In our general language that we use, that would be your reduction in market value of an asset. When you buy a new bakkie, the moment you drive it out of the dealer's floor, it reduces in value, in the market value of that. But in accounting, it's something else. Then we refer to the estimate, we estimate the useful life of an asset. And obviously different types of assets have different values. Buildings normally have a 20-year useful life, also depending on what type of building it is. Your vehicles and so on, tractors and implements, normally we look at 5 to 10 years. And then you have consumables like things that you use in your dairy on a daily basis. Computer equipment, for example, has a different value and can be written off over a shorter time. So you depreciate the net book value over the time of the value or the useful time of the asset, and that you can do in two ways: either on a straight line. So let's say we refer to a building, 20 years useful life, then every year you write off the same amount. Let's say, if it's a building of, make it the sum easy, 20,000 Rand over 20 years, every year you depreciate that with 1,000 Rand. Or you can use the accelerated method, and that's normally in the case of implements and other equipment, where you do it over 3 years. The first year you write off 50%, second year 30%, and the third year 20%. So that's an accelerated way of depreciation. It's important to note that the net book value is not equal to the market value. So after year 3, your Hilux can be, in terms of your book value, can be 0 because you've written it off. but actually you can still, sell it in the market for 400,000 rand. So your net book value and your market value will always differ in terms of implements, tractors and other stuff because of the difference in depreciation. Also important to note, is that depreciation is it's not cash that's leaving the business. It's mainly an accounting line that you've written in your books, in your financial statements. So it's not cash that's going out, so you don't lose that as such. Although you might see it as a loss in your market value as time proceeds. Some more basic ratios. If we look at your debt asset ratio, that's the amount of debt that you own versus the number of assets that you have. And generally for agriculture, we say that anything less than 40% is a healthy scenario. If you own in terms of your debt less than 40% against your assets, then you're in general you will be fine. But there's a lot of industry variation into that. For our intensive industries, that ratio might actually be bigger. It can be up to 60%, for example. For our more extensive livestock operations, we prefer to look at something less than 20%, because of the industry scenario that plays out in that. Then your liquidity. That's your current ratios. Liquidity means that how quickly can you transfer or convert the things that you have into cash, to make sure that you cover all your short-term requirements. So your current ratio, that's your current assets. That's short-term assets like your vehicles, for example, against your current liabilities. And that's a healthy ratio there would be 2 to 1. So if for every 1 rand liability that you have, you at least need to have 2 rand value in assets. In terms of profitability, we can measure a couple of things there. We normally look at your total capital profitability measure, where you take your net farm income times 100 and you divide it by that to your average total capital over a specific year. And then anything less than 10% in the agricultural industry is actually good, because if you look at livestock farming, it's normally in the region of 8%. So anything more than 10% would definitely be a good profitability margin. Moving over to some key financial statements, and that's the boring part. And I'm grateful that Helena put me, second in line, because otherwise you would all fall asleep if you've done this after lunch or at the end of the week. But some key financial statements. First is your balance sheet. That's your statements of a financial position. It's normally a snapshot or a photograph of your assets, your liabilities, and your creditors on a specific day, and it's normally on day 1 of a business or day 1 of a financial year. But it's a very important source of information, and specifically for us as financiers, in terms of your short and your long-term debts. In anything that you own, or owe to somebody else, will be in your balance sheet. It's a good reference to your gearing, where you and gearing means the amount of debt that you have against your assets. Also a source of information about your reserves. So how did you perform over the last couple of years? Because reserves will be worked back into your balance sheet. And then your capital assets, and obviously cash on hand, will also be reflected in your balance sheet. It's also a thing that or a statement that we use to measure your return on investment or your return on equity, which is also important. Then a second one, a more common one, would be your income statement, or in other terms, your profit and loss account. That's your statement of all your income and expenses, which include fixed and variable costs. It includes your cash and non-cash transactions, because depreciation is included in the income statement. But not all expenses will be included. If you have certain big capital expenses, that will be directly included into your balance sheet. But your income statement is a very important information source for your EBITDA. And EBITDA is your earnings before interest, tax, depreciation, and amortization. And your EBITDA, and we'll come back to that, is a very important one when you apply for finance at any financial institution, because that's the number where they look at your sustainable EBITDA levels. Is that important one? That's the measurement of a company's operating performance, and that will show a bank or a financier how good a company operate before there's any interest or tax or depreciation applied onto that income statement. Now, and for you that have any accountants as friends, this is normally the look that they get on their face when everything balances in the financial statements. It's normally a tricky one. So if you look at a cash flow statement, your cash flow statement differs from your income statement, since this will only include your cash transactions, which is obvious if you look at the name. And that's where the difference come into, the difference between cash versus profit. So if we look at your cash flow statement, then you come to our financial planning, because those are the documents that you have, and then you do your financial planning. So if you look at financial planning, it's not something that you do only for your retirement, which a lot of people think it might be. Financial planning in a business, whether it's a veterinarian practice or a farming enterprise, it's a continuous process. It's an important one, because that will in the end determine how you perform. So what should be part of this planning? I think first of all, your business plan. And if you look at your business plan, that document, it says they're a live document that you use for the sustainable functioning and management of the business. It's not something that you do once off and then you put it there in the third drawer of your desk and you forget about it. You must actually review that on a continuous basis. And then your financial statements, which we spoke about, those irritating documents that the accountants love. But actually, it's very crucial for you as a business owner in terms of financing, but also in terms of management. And I've referred to that when you do performance analysis as an example. But it's important not to do it alone. If you do it, or if you're in a partnership or a company, it's important to involve your partners, but also your financier. And I'll get back later to that, where to involve your financier as well. Then your business plans and budgets. Those are the policy statements of the business. As I've said, it should be live documents that needs constant revision. It's not something that you do for the bank when you apply for finance. You must monitor it, or must use it to monitor your business performance. Then it's important to set benchmarks. Benchmarks is something that's been neglected in the agricultural industry for some time. But it's something that you can use to compare yourself against your peers. against your neighbor or against other veterinarian practices to see if you still perform as you should perform, and then obviously make adjustments accordingly. It's also important to ensure that there's space on the budget, and by space we mean, can the business overcome unforeseen circumstances? We've seen during the pandemic a lot of businesses that didn't have enough space on their budget in terms of a loss in income, for example, or increased costs due to sanitation requirements or whatever. So it's important to leave space on your budget for those unforeseen things that's going to happen, but also space for new things that you want to do, and you need finance for. And then when you make assumptions, it's important to test those assumptions against objective people, and also criteria. Find yourself a mentor or find yourself a colleague, or somebody that you can speak to check those assumptions and make sure that it makes sense. With budgets, sorry, I went back. So the cash flow budget, that's probably the most important one when you look at applying for finance. For us as a financial institution, that's the thing that we focus on. So when you do your cash flow budget, you must apply the SMART concept. You need to be specific in what you budget for. The budget must be measurable, because it's easy to say, we do this, but how do we measure that? How do we know that we've achieved it? It should be achievable. It's nice to say we want to make R1 million, but we only have 1 hectare, so it's difficult to have a profit of R1 million in 1 year on 1 hectare. That being said, it should also be realistic, and you need to put a time frame to it. Let's say we want to milk 1,000 cows. By when would we want to milk those 1,000 cows? So put a time frame to it so that you can work towards those budget requirements that you have. Then, if we look a bit further into the finance, we're looking at the lender's requirements, because your financial statements should be, it needs to be able to give us as somebody that uses your grandma's money to convince us to give that to you to make money with that. So it should be affordable. As I've said, cash flow, that's probably the cash flow budget is the king of all the statements that you supply to a bank when you when you apply for finance. In terms of ownership, obviously the bank will not extend credit greater than the value that you own in the business. So if you only own 50% in that business, the bank will not extend credit to you for 75% of that. Important to note as well. Obviously, in South Africa, we still finance on security as basis. So you need to have sufficient assets to offer as security. Then banking the jockey is becoming more and more important. As we move and there's some pressure on the financial system in terms of the assets that's available, we also look at a jockey. The jockey meaning you have to have sufficient knowledge, the skill and the experience to manage the business, to achieve the indicated financial results that you've set out in your business plan and your cash flow budget. But if you don't have those, you must show the willingness to get expert inputs where these things are lacking, to see that you can over time achieve those skill requirements, and you will be a jockey that is bankable. Then also important to note that when you apply for credit, apply for the credit that match the purpose. If you look, for example, at long-term loans, that's normally 10 to 15 years loans. That's what you use when you buy land or when you do fixed improvements. You don't use long-term loans to buy cattle or to plant maize which is a 1 year crop. Then your medium-term loans or project loans, and that's normally 5 to 10 years. We would like to do expand your production capacity, and very important for livestock purchases. For livestock purchases, we normally work, especially on cows, on a 7-year period. That's the most general one. And then your short-term or your seasonal production credit, that's to finance your production expenses or your normal running costs, and that's normally done via an overdraft. So it's a 1 year, normally a 1 year period for that. But obviously it will extend or it will recur over time. As I've said, we measure a lot of or do these measurements, and we compare that to clients in terms of benchmarking. And this is just a small extract from one of our agric reports, what we look at, and we compare that against peer clients. Whether it's in the same district, the same industry, or comparable clients in other industries or in other areas of the country, to see where you as client one will fit in against the rest of the industry. Some credit guidelines. Intensive agriculture, and that's where your dairy operations, feedlots and piggeries normally fall in. It's a complex, normally a complex structures and of complex nature, because it requires specialized equipment. It's very capital intensive, and it normally also requires specialist skills. It's not everyone that can run a dairy, and the failures of the operations will most likely result in significant losses. Just imagine, the capital investment into a dairy parlor. If that business goes south, there's significant losses, and obviously a risk for the bank as well. So in terms of our intensive guidelines, if you look at the guidelines, if you look at the debt ratio, we've said, in terms, normally 40% is a healthy one. We can look at 60% for intensive production systems, 60 to 70% within the bank. And just to note that this will differ from other banks. This is now only applicable to First National. And then livestock, and it's specifically extensive livestock, 35% is most probably the max. In terms of your gearing, you can see for the intensive one, normally 80 to 100%, most likely closer to the 80%. And then lastly, just one on that, your interest cover should be at least 2 times. So if you look at your EBITDA number, it should be at least twice that of the interest payments that you make over a period or in a year. You must also take note, as the interest rates change, these things change as well. So, and that's why we said that budgeting is living documents. So where do you fit in, whether you're a farmer or a vet student or anyone in the supply chain? Obviously, if you look at and specific for the vet industry as specifically, you are very responsible for the health of the herd for a farmer, the reproduction rates, cull rates, and management of that, and that all boil back to your production, your milk per cow per day, which is the most important one for the farmer. Because if he doesn't have that, you won't be able to be a sustainable farmer. So, as a vet or as a nutritionist or as a farmer, and obviously farmers make use of all of these, in terms of your on-farm expert groups, and that's where the jockey is important, where he is willing to make use of these experts in his operation to make sure that he's sustainable, or he can produce sustainably. Or in some instances, farmers, a group of farmers employs a vet between them or a nutritionist, between them. Normally in your more intensive production systems, KZN, Eastern Cape, those areas where, let's say, a group of 10 to 20 farmers have one vet which they employ between them. Then obviously in consultancy or a normal vet practice, and then from time to time, we as financial institutions might request expert inputs when we have very complex loan applications, especially when it's big applications with big players in the industry. And then some other lawsuits, not the nicest one to be involved with. So as far as possible, keep away from that. But that's also important, where you also need to give expert opinions in. But it's important in the end, and I've referred to the change, to make yourself relevant. Darwin said, and you will know that it's not the strongest of species that survives. It's also not the most intelligent ones. It's the one that's most adaptable to change. So if we look at change and change management over time, I'm sure there's a lot of people that, and I can't ask the question and see how many of them, but that previously had Nokia phones, which most probably don't have Nokias anymore. Most of you probably sit with a Samsung, Huawei, or an Apple phone that you might even look at this webinar on. But things change, and I would like to show you a time lapse of how brands changed over time. Take note of the ones. There's Nokia, and I hope my thing is visible. Nokia is up there, as I spoke to. Look at Microsoft, and this is not long ago. This is about 2018 is about 14 years ago. But look at the movement, but also look at the countries where these companies hail from. Look what happened to Coke. There's a new one, Apple, as I've mentioned them. Look at the growth that they've achieved. Well, 11 years ago. Samsung on the board. There's a new one, Amazon. And if you look at the top companies 10 years ago, it's all IT companies. Up to, Walmart is most probably the only one that's not an IT company. They're in the top 5. There's a new platform on Facebook coming onto. You see our platform industries have outperformed your traditional industries like Toyota and Coke, that which dropped off. So this ends in 2020, just before COVID, uh, or the peak of COVID. So it would be interesting to see how that changed over the last 2 years. But you notice the top six companies there is platform companies. So why does I tell you that this? Now you must decide who you want to be. Do you want to be a Nokia? They had the best phone on the market for a long period, but unfortunately they drop off that board substantially quickly or very quickly. Do you want to be an Apple, which is the new kid on the block? A quick rise over the time. Uh, I think they ended off number 3, if I remember correctly. Or if you took note of Microsoft, they were up there from the start of the last 12 years or 14 years. They were constantly on the top 4, top 5. I think they ended in number 4. So for you in the market as a farmer or as a service provider to the farmer when you are a vet, you need to stay relevant, like Microsoft. They've adjusted and their products, their service delivery to people. They keep up with technology, and with that, they stayed relevant. They've adapted to changes in the market. They've anticipated that, and they've seen the changes coming, and they've adapted to make sure that they are still relevant to their customers, and they are informed. They know what a client wants. So for you as a vet, you must know what your client, the farmer, needs and wants, and adapt to that. And for you as a farmer, you must also know what your client wants, whether he's the milk buyer, which you deliver to, or whether he's the consumer, the end consumer, which you might also be delivering to into a niche market. Know what they want, and adapt to those changes in the market to be sustainable in the future. So in summary, the importance of financial management cannot be understated. You must monitor your financial performance in your own business to make sure that you're sustainable, because from time to time, and unfortunately in agriculture, most of the time, you need to use those financial statements and financial plans in the application for finance. There's not a lot of farmers that can farm cash in nowadays. Then you must know where you fit in this whole chain in the dairy industry. But it's important to make yourself relevant. Otherwise, you definitely will fall off. And then adapt to change. Adapt to a changing environment. Better yourself for the good, to make sure that you are in the long term sustainable and in the market. But most importantly, don't lose your focus, because if you lose your focus, unfortunate things will happen. Thank you very much. If there's any questions, I'm happily happy to take them.
Okay. Any question for Dawie? You can either use the chat box or raise your hand through the icon. Okay, Dawie, ultimately you cannot have a sustainable dairy business without understanding your dairy economics and your dairy financial management. So, and as you said, it's very important for a farmer or the other people in the supply chain to connect with the expert groups to understand the whole dynamics of dairy farming. So thank you so much for your presentation.